In this episode, my friends Michele and Junior share with us their experience in becoming their own bankers and the infinite banking concept, and they have about 11 plus years experience. And I thoroughly enjoyed it. I think it's very valuable, and I hope that you enjoy as well. All right, are y'all ready to get started?
Yes, we are.
Absolutely.
Perfect. Well, let's go. Welcome to the Banking with Life podcast. I'm your host, James Neathery, and today I'm as excited as I can be to have my friends, Michele and Junior, with us to share their experience on how they became their own banker. I'm excited for you. I'm excited that you get to know them, right, and you get to hear their story and their background. They've been friends for going on about 11 years or 13 years.
13 years.
And so... And that's really kind of where I want to start. You know, we met 13 years ago, and give us a start there and just progress forward and why y'all are here and why these people need to hear you and why it matters.
Okay.
Well, James, as you recall, we met at a swimming party at our friends Steve and Christy, and that's where it all started. We were just kind of, just talking, and from there, that's where we met, and then... down the road, you found out that my wife knew a little bit about Excel, and that was kind of the start.
And a little bit about Excel, she taught Excel, right? So she's an Excel ninja. And so that was about 2007. Mm-hmm. You had gone to work the same place that Jen and my lovely wife was working. So we were all at the same pool party there. Mm-hmm. And great conversation because y'all are very cool people. And then... found out that you were an Excel ninja. So I'm like, hey, Michele, there's you can take life insurance and get out of debt with life insurance, but it's a hard concept to kind of convey. And sometimes, presentations or examples help us. And so I asked if you would run an Excel spreadsheet showing how someone could get out of debt with cash values. And you graciously, and I think even the whole office took some Excel courses,
Yeah, I came in and did some basic Excel training, and then we talked a little bit more about your vision of what you thought that worksheet needed to look like to demonstrate to people how the get out of debt, create wealth worked. And just seeing that model and working through it was like the light bulb went off. I'm like, well, this is pretty cool.
It really did have the potential to work.
Yeah.
Right.
So after doing the worksheets and understanding or beginning to understand how, you buy your policies and then you pay down your debt, and then at all that time you're still creating some capital or cash value that you can just keep using over and over again. So,
do you know how many cases you ran through that model trying to, we were really trying to perfect my vision of what I thought it should look like. But it's very difficult to put cash values of a life insurance policy, in an Excel spreadsheet because they're not linear. The cash value is not linear. The dividends fluctuate. So it's not really easy to do it. And then especially if you have, multiple debts or loans or credit cards, and then when you introduce multiple policies into that, it can be very complicated. And but my whole idea was to be as accurate as possible and just convey the idea that it was possible to actually get out of debt and build capital faster. With a life insurance policy, buying a policy, high premium, high cash value, and then deploying that cash value through the loan provision to take over third-party or outside debt. And then as we repaid the loans, we're still paying premium. That compared to, get out of debt first, just pay all your debt down, then start saving money, which is nothing, there's nothing wrong with that. But if you do it with life insurance policies, that whole time period happens faster. You might get out of debt faster by paying all of the debt down. Then you're in a position to save, quote unquote, save money. And at the end of that time period, when you go out 10, 12, 14 years or whatever, you're way ahead with the life insurance strategy of getting out of debt. But do you remember how many?
Seems like you gave me like different scenarios, like maybe with, I don't know, maybe with a couple high debt in one policy, maybe with 2 or 3 policies and a lot of debt. I don't remember exactly, but it seems like you gave me several scenarios to work on, and then I worked on them on my own and then met with you and I think it was Jake. I'm not sure who else it was, but somebody else in your office. We had worked together to kind of perfect it, because I think you were trying to use it as a preliminary to show people how their wealth could be created before they got and bought a policy, I think is what you were trying to do with it.
Yeah, I was just trying to show the idea that, if you're drowning in debt or you have a lot of debt, and if you add discipline to that, and high cash value life insurance, that even though you're starting with a lot of debt, it's okay to not wait until you're completely out of debt to start saving money. And I do remember, you coming in and I think back then it was like, I just wanted to learn how to do the Excel spreadsheet well enough where we could do it, but quickly discovered that it was really above my pay grade, too complicated for me. And I love math, I love numbers, I love formulas, but and then like you're the ninja, and I'm like, hey Michele, would you do this? And you said yes. And but I also remember you asking James, can we do this? So.
And the reason, James, that she asked that is because we had gone through some rough times in our life, and we were, pretty much, we had a lot of debt. And we saw a way where, maybe we could work ourselves out of it. And so that's why, that's what started the whole thing.
Right.
And we had been through, several financial advisors putting it into, I don't even remember what we put them in, mutual funds and who knows what else. And we'd give them our money and we'd never talk to them again. And so we were like, this has got to be something better than this, because we're putting our money and we don't even know what's happening to it. So, and we had another friend that we had worked with, but it turned out to be just as bad as the other policies, other financial advisors that we'd had, because they sold us this big story, but we never after we signed with them, we never talked to them again. It's like, well, is it really working? We don't even know what we're making,
Like life insurance policies or?
No. They were tied to the stock market, and of course, 2008 didn't help matters any, So.
Right.
I don't even remember what they were, but it was
just another financial advisor.
Yeah. Mm-hmm. So mutual funds, I think some, and
yes, stock.
Yeah, I don't even remember what kind of what they were that they were in, but we were not happy. So then when we heard you talking about what we could do with life insurance policies, it's like, well, what do we have?
With a life insurance policy, really?
What do we have to lose? We already don't know what we're doing, so why don't we start with something brand new? So,
and that was, y'all have, and I just looked. What little preparation I did. I've been waiting. I've been so looking forward for y'all to come on and be guests, because people need to hear y'all, in my opinion, right? But I don't do a lot of prep work generally. I just like to sit down and free flow conversation. But I did peruse the amount of policies that y'all own, and y'all own more policies than I realized. But if we go back, y'all were able to hear Nelson. That was back too, far enough back when we were hosting Nelson 2 or 3 times a year. Mm-hmm. And so I invited y'all, and y'all had to pay to get it, to attend. And
I think we saw him about 3 times.
2 or 3 times.
Maybe twice, I don't remember.
Yeah.
But enjoyed listening to him. It was awesome.
It helps, didn't it?
Uh-huh.
And meeting other people that, are going against the grain, swimming upstream, or doing what everybody else is not doing.
Exactly.
You could probably count on one hand how many people that pay high premium, high cash value life insurance, right?
Nobody else other than us, I mean, I don't think any of our family, other than our kids now, because we're starting to teach them, and I think the thing that I remembered the most about Nelson Nash was his grocery store example. And of course I had read it in the book too, but then hearing him say it just explained it even better. I mean, he was just such a dynamic speaker. He got you into it, so. Did
you feel, because I always say, there could be a room full of people, and when Nelson was speaking, I always felt like he was talking directly to me, like there was a real connection. It wasn't just a presentation being given. Did y'all feel that way?
He was very personable, and it wasn't a whole lot of people that you had in the group, so that, anytime you keep the crowd smaller, then it is more personable. Yeah. So
I remember his rose, talking about the rose and the family it came from. But he was very entertaining. I mean, he kept your interest up. Very good speaker.
Yeah. So when y'all started, whenever, he said, well, can we do this? And I said, yes. And I think, going through the spreadsheets, I recall that you came up with your own premium dollar amount. What's the relationship of cash value if we did this much premium? And you pretty much was kind of working your own situation through the Excel spreadsheet. And that's how the first set of policies really developed. Is that an accurate memory?
I think that's the way I remember it too.
You said we have a lot of policies, James. We bought our first policy from you in 2009. And of course, since that time, our children have gotten married, and we've got 5 grandchildren. So that's where, a lot of those come from. But, it's not like we're talking a lot of years that we've been with you and doing our policies. So we just saw how this thing can work, and we wanted our kids to be involved, and we want our grandkids to be involved. And that's where we're at today.
Right. And if you think about that, that's 3 generations to your grandchildren, and you're really going to touch the 4th and the 5th generation just by what y'all have done, if just some of them follow in your footsteps. Mm-hmm. I mean, but right now, 4 generations. 4. It's like,
wow.
Pretty powerful. I mean, the bankers aren't looking out for your grandchildren and your great-grandchildren. Mm-hmm. They're not.
Nope.
So that's very powerful. So would you share maybe some of the things that y'all have done with your policies?
Well, I can tell you the first thing that stands out is I bought my truck with it, and we recently bought Michele's new car. So we bought 2 vehicles. We remodeled our kitchen. What else did we do?
We helped the kids pay off some of their student loans.
Yes.
Because when they were in college, we weren't able to help them at that time. And so we were able to kind of pay back, what we couldn't help them with before.
What's that worth?
A lot.
Absolutely.
No monetary value. It's just,
right.
From your heart. Cause,
can't put that on a life insurance illustration.
Yeah. Because when our son went to college, we were both unemployed. So we're like, okay, we'll figure out some way how to make this work. And then when my daughter went, I think I had just got a job. So we were just at least had a job, but we were pretty far in debt. So
yeah, we went through a rough time. Where I lost my job in 2002. So now you got my wife wasn't working. Very fortunate that she didn't work while I was working. But now all of a sudden you got 2 unemployed people. And so we accumulated a lot of debt. I mean, a lot of debt, and we were just trying to hang on. And one things I like to bring up is in some of your other seminars that I've listened to, you talk about marrying up. Yeah. Well, I'm married up.
No question.
I was going to say, is this where the part where I say, or I interject, I'm married up?
It's obvious, right? Junior's a great guy, but he didn't marry up.
You talk about testing, when you go through some financial difficulties, that's when you find out, how strong your marriage is, and because it was tough. I mean, it was really tough for us. But hey, we've come a long ways. I mean, we've followed that plan to a T.
Y'all have.
It's got us out of debt. I'm retired now.
Congratulations.
Thank you. Trying to work with my wife getting there, and it's coming. to where, she can do what I'm doing. But it all started with meeting you. I've told a lot of people that James Neathery has just turned our life around.
Oh, thank you. I appreciate that. The credit goes to Nelson Nash and y'all. It's all conversation until you write a check, and when you're the ones that paid the premium. You're the ones that had the discipline to deploy the loans correctly and then to repay the loans. So y'all been phenomenal. If everybody would follow your example, there would be a lot less problems in the world, I promise you.
Yeah, but I'll refer back to what Michele said, and with previous, and I'm not trying to knock other people. That's just the way I think people are. They're so busy, and they go, okay, I got to move on to the next, but they don't spend time with their clients, and can't say that about yourself. We've met several times, and initially we really, because we had a lot of questions.
Sure.
And
Well, thanks for saying that. I am available. I'm not available on demand like anyone else,
right.
But I like to think we have a pretty good team here that they're very able and capable. And
oh yeah, very.
Absolutely, yeah.
It's like I don't do very good on policy service. It's like if I want a loan, I walk right up to the front of my office and say, "Hey, Carol,
yeah,
on a loan repayment, I can calculate all that, but if I have to sign forms and things, I walk right up to the front of my office. If somebody calls me and asks for service, I'm like, you know what, Carol's better than I am."
Yeah, she's awesome.
Yeah, absolutely.
She's awesome.
Got great staff.
Anything we ask, and just, it's not like we meet all the time, but we try to schedule at least once a year to go over where we are and our game plan for the next year. Like, what did we do last year? Now what do we need to do next year? Right. And when Junior was getting ready to retire, I remember a couple years ago, maybe 3 years ago, we did that. We're like, okay, well, we got to do this and this in order to get to that point. And now that he is retired, we actually are taking that money and rolling it into a new policy so that we can keep it going, so it's just not sitting in a savings account. So just the planning, everybody that knows me knows I'm a planner, I'm a list person, so to have a plan in place, now granted the plan doesn't always go the way you want it to, but to have a plan to know that if I can put this much money in and I can do this, then I can buy my car, and then I can basically use my money to pay for my car, and it's free. I don't have any interest, so.
Well, the experience looking back, what would you have done different, if anything? What would you do different knowing what you know now compared to, 2009 when you started buying policies? Would you do anything different?
We would have started in 1986 or 84 when we got married.
That's exactly what I just said. If we could rewind the clock and just start earlier.
We would have started a long time ago.
Although based on our situation, James, and where we were at, I don't think there's a whole lot we could have done different.
Right.
With our finances at the time and stuff. And that's why, I remember your advice on here's how you, I was once asked, how do you eat an elephant? Okay. And I can relate to that. It's one bite at a time. And that's kind of what you gave us. Okay. What you do is you attack this one here. It's got the highest interest rate or so that's where it all started. And just one by one, we Pac-Manned them up. And then one day they were all gone. And honestly, we used a cash out refinance on our home, and took that equity money to pay off a lot of that debt, and then start getting our PUAs going in our banking system, So.
Yeah, and our house. Back when we were both unemployed, we didn't know how we were going to keep our house. So it's kind of funny how our house actually helped us with our plan later on down the years, but we did everything we could to keep our house. So thank goodness we did, because otherwise we wouldn't be where we are now, for one thing. But
right.
But yeah, we did everything we could to keep that house, and it was like some months we were like, we don't know where the house payment's going to come from, but somehow we managed, and then we started getting other jobs, and then we were able to keep it. So it's kind of funny when you think about it. At one point we're like, how are we going to keep the house? And then now, in 2015 we were able to use it to help build our cash value more.
So in 2015, the cash out refi, so you're leveraging the equity in your home, putting it where, in my opinion, equity should reside in life insurance policies, but y'all had already you'd already purchased policies. You didn't start with the refi to go fill up life insurance policies to collateralize them fully. Y'all had 6 years, 2009 to 2015, to reduce some of the debt, and what I like to say is to solidify the discipline, which are very disciplined people, no question. But by the time the home equity loan was done, y'all had substantial cash values, and you were already practicing banking. And there's a lot of that out there in the big wide world about HELOCs. Should you start with borrowed money to start policies? Can you do that? Yes, you can do that. Will it work? It can work if everything else is, working and there's no problems. But so that really accelerated y'all's outside debt elimination, right? And it increased your ability to control the banking function as it relates to you and your personal economy. And y'all could probably pay off your home if you wanted to, couldn't you? I'm just saying.
We probably could.
We could.
But because of your philosophy that, why do I want to pay off my home and have all that money in a house that I can't get to? I mean, that's how you explained it to us, was as long as you're working, you can pay off your house, then if one of us does pass away, then it's going to be paid off by the policy. So why not use our money from the house in something else that we need right now? I mean, I still remember when you told us that.
And I made the case either way, right? Because you can make a case either way. You can pay off the home and you free up that cash flow and start building wealth with that debt service. Or you can cash out refi. You have a place to put that money, and then leverage that in those cash flows to reduce debt. It's really just velocity and arbitrage is all that is. And you can make a case for either paying off the home or not paying off the home. And then when y'all we determined, but y'all determined it was best for y'all not to pay off the home. And here, a few short years later, this is my point, that if you wanted to, you could pay the home off. So being in the position of having the ability to pay the home off is sometimes more powerful than actually paying the home off or any other debt.
Exactly.
Right. So.
That's exactly right.
All right.
And then, before we started the program, we were looking at our cash values, and you mentioned that they're going to continue to increase. So that's exciting. Yes. I mean.
Today's Saturday. The markets aren't open, right? The cash values are increasing. The markets aren't open on Sundays for most of us, right? And our cash values are going to keep going up. Every day that our feet are on the ground, the cash values are going to increase. Just by design. You don't have to do anything. They're going to go up one way. And really, it's surprising. Very often, we look at illustrations, we decide that, yes, this is what we want to do. We start paying premium. We see the numbers, that are in the illustration in the 4th, 5th, 10th year, whatever. We see the numbers on the illustration. But it's very common that, after a year or 2 or 3 goes by, we're still kind of surprised that there's so much cash value available. Even though we looked at them and we expected them, we hoped that the life insurance company was going to do what they said in the illustration. But it's still surprising sometimes how much capital and how rapid the cash value accumulates. Did y'all experience that at all?
Well, when we look at our statements year after year, we're like, whoa. I mean, because like Junior's policy, we haven't taken a loan out on it for several years. And we're like, whoa, it's increased, substantially in 1 year. You can't, and we didn't have to worry about the stock market. We didn't have to worry about, is the Dow up or down or whatever. I mean, you don't have to worry about any of that stuff. And to me, that's just, you can control your own money much better. You know what's going on with your money, because at any point I can call your office and say, or look online and see what the value, how much I have available for me to take out a loan. And I don't have to have a bank to approve it. I have to sign a piece of paper, and your team sends it in for me. And then a few days later, I get a check or get it into my checking account, depending on how big it is. I mean,
One of the things that I forgot to mention, or we did, whenever you asked tell some of the things we did with our policies. Our son, with his, he used it to help him. I mean, with his down payment, some of it. He had some, and then used some of ours just to
a down payment on a home.
On a new home, yes. So and that's a policy that we converted, if you'll recall, from another company, and went with our company, and and then we added capital to it to build them to get their banking system going, and here it is at work.
So, yeah, and I'm typically not a proponent of replacing policies, but when it's in your best interest or the client's best interest, so you can't do it quick enough. If it's right, it's right, and if it's wrong, it's wrong. So, and I vaguely remember that. I do remember that. It was a legitimate company. There was nothing wrong with the company.
No. We just wanted to capitalize it, and that's, and we could do it.
Increase the death benefit,
exactly.
too.
And we also, substantially.
Right.
And they're young, our kids are young, so it was a good time to do it. And
right.
So,
yeah, I remember doing it. And man, when it's right, you can't do it quick enough.
Mm-hmm.
Yeah.
So, and then when y'all make your children's, when you make loans to them or help them with these things, do you require like a loan repayment? Or, and if you don't have to share anything you don't want to. I'm just asking though, do you have y'all set up like family guidelines or family rules? Have y'all had those kinds of conversations?
Well, with our daughter, she's now the owner of her policy. She has, taken the steps to make it her policy.
Okay.
So, and she's got a payment plan going. So she's paying her. She used hers, if you recall, for her student loans, and so she's already.
I love that.
She's already got it set up on a bank draft. And our son is we're in the process of talking to him about getting his converted to him, so it'll be his policy.
Just change of ownership. So, in those the policies on the children, did we 1035 exchange from the previous company
Yes.
into those?
Yes.
Okay.
Yes.
So really then, and I know I should have a better memory, but I think that y'all started those original policies when they were pretty
babies.
young.
Yeah, they were babies. They were
Okay.
babies. And it was just a minimal amount.
It's like a $15,000 policy.
Yeah, it wasn't very big.
So they were originally started for the benefit of your children anyway.
Mm-hmm.
And so years later, we just increased that value or the benefit by the 1035 exchange, structuring them where they can have more and more and more. Mm-hmm. And now you're in the process of giving them, transferring wealth from one generation to the next. Now, not that it's a bad thing to have to, meet with attorneys and things, but did we have to do a lot of work to get that done? Did we have to meet with anybody?
No, it was
get that done?
papers. It was paper signatures. I think the hardest part was getting a hold of the other company to get the right paperwork, right? If I remember right. But it was just paperwork.
Their policy was you had to meet with the agent personally.
Oh yeah, I remember they were draconian. It's like I remember that as some companies.
So anyway,
your agent had to sign off like he had to approve it. And I won't go down that road, but he probably disparaged the new company and and my character. But once that was done, though, whenever you're transferring ownership from yourselves to your children, we didn't have to do a lot of.
No.
It was a piece of paper.
Yeah. And then the loans, I was talking to a client the other day, and he said, James, the requesting a loan online is so easy. I accidentally requested a loan, and I didn't reverse it, and I got a check. So can I just send the check back? And I'm like, wow, that's pretty easy. And my point is this: it's relatively easy to get a loan.
It is. Yep.
But it just ties right in with what you said. It's our money, so.
And like the car that I just bought, it was kind of a spur of the moment. It was kind of like all happened pretty fast. It was just, I want this car. I don't want to wait. And it happened to be the same weekend that everything ended up going in lockdown because of COVID-19. It was like that Saturday, and then that Monday, everything almost shut down. So it was kind of weird. But anyway.
Still is.
Still is, yeah.
Yeah, really.
But anyway, so we were like, no, I want this car. And so what we did is we just got our loan from the car dealership and paid a little bit of interest until we got our money out of our policy, till we got
It's
our
like
loan
5
money.
days or something. I think,
And then
4
we
or 5
paid
days.
it back. And so we paid off the loan in like less than 30 days.
But you're driving what you wanted to drive.
That's right. And we saved, I think I figured up,
For the 2 cars, we figured up we saved about $5,000 in interest.
in interest payments. So
Wow.
it's basically free money. You don't, yeah, you have to pay, they charge you interest to take your money out, but then when you start paying it back, they pay it back to you. So it's free money.
Well, there's
money.
there's an interest charge on the loans, right? But if you're paying, especially if you're paying back, and I don't know what the interest rate on car loans are now. Is that a pre-owned cars? Or
Yeah, it was a
It
pre-owned.
was a pre-owned car.
I think
yeah.
it was. I mean, it was less than 3%.
on a pre-owned? Perfect.
Well, it depends on your credit rating. I mean,
Sure.
but at the time we looked at it, was it 2.8? I think, or was what they had told us. So.
Yeah. Well, my point is that when you borrow money, you're collateralizing the cash value. The insurance company is going to charge you interest. And it really depends on your repayment schedule, how much interest you actually pay, right? And if we all valued our money as much as we value the third-party lender's money. See, I wouldn't loan money personally at 2.8%. My money has more value than that, right? As a matter of fact, I'll take all the money that you'll lend me at 2.8%, right? But how much we actually pay in interest to the life insurance company depends on how fast we pay it back and at what rate we pay it back. But if we pay the additional interest above what the life insurance company is charging us, so if a company charges me 5 and I repay it 7, that additional 2 points goes into my policy. And it's just premium to my policy.
Right.
And the more premium I pay into my policy, the more cash value I have, the greater, more death benefit that I have. And then I cause even future dividends to go up. And most people don't realize that you almost can't put enough money in life insurance. Once you see what's going on, properly structured life insurance, you almost can't pay, you just can't pay as much as you really want to, or as fast as you really want to. But
The other thing real quick on that loan, though, is because, back in March in COVID, we were like, what is this? We don't even know what's going on, right? So I was like, well, what about my job? I don't know. So when we did our own loan, we didn't have to worry about, well, I might lose my car. Well, if something had happened to my job, which thank goodness it hasn't, and hope it doesn't, but if it does, I still have my car, and I don't have to worry about making payments if I can't.
Them
make
taking
payments.
it back.
right, so you control the loan repayment.
Right.
Exactly.
Right, you can pay interest only, no interest. You can skip payments, double payments. You can do what you want to do, and nobody's going to show up repossessing it. Oh my goodness!
And and more I think about it, I think I could be off on the interest rate charge. I don't recall. I think that might have been what it was on new cars and going on. I don't really remember.
And
We didn't discuss it because we had already planned what we were going to do.
didn't care. You don't really care what the interest rates are,
Right.
Exactly. So,
right? Because it's really not a function of interest rates. It's a function of building capital and you controlling the banking function and just the movement of money throughout our lives. That control from, being in crushing debt, right, at one time to being in a position that I don't care what the interest rates are. I'm going to do what I want to do because I want the car and I want it right now. Why should we wait to have nice things? We shouldn't, especially at my age. I don't want to wait. Wait for what? I mean, I'm not going to willy-nilly buy things that I don't need or don't want. I mean, we're being prudent. But at the end of the day, from uncontrollable debt almost to controlling the banking function in your life, I mean, your blood pressure's got to go down. Just the nirvana in general is like, man, this is the way I want to live.
Yep.
That's powerful.
yeah.
Junior, would you share with me, or would you be willing to share with me the story of your friend on the golf course?
Yes.
Can I or not?
And I just bits and pieces of what he told me. He paid in. He was paying. I think he said $69 a month and he paid it for years and years and years. And then
into life insurance.
Into a life
policy?
insurance policy, yes. And so one day we were just talking, and I was telling him about how excited I was about having a life insurance policy that did wonders for me. And he goes, man, he says, how did you do that? And I go, well, I can't explain it to you. You need to talk to James. But anyway, basically what happened to him is it ended up lapsing. And they sent him a note to the effect that, he didn't have his insurance. And again, I don't know how to explain it. It couldn't cover the premium anymore. He kept paying it, but I guess at the end of the policy, I don't know. You know more about those things than I do, James. So.
Right. So he had to pay more premium. Right. The policy was
yes. They were trying. They were coming to him for more money.
Right.
And
he'd already been paying for years and years and years.
$69 a month, he said, for I don't know how many years.
Right.
It's a $100,000 policy, and it was a whole life policy.
Okay.
And, I don't know how you don't build up enough cash values at some point, pull some money out of it is what I couldn't figure out. I don't know enough about it to...
did he wound up losing the policy?
It lapsed on, yeah. He ended up he didn't have the money to come up there.
Yeah, I wonder if he, do you know, and I don't know, so it's a question, do you know if he was ever in contact with his agent in the last several years? Or?
Well, a friend of his sold it to him, and I think he ended up getting out of the business. So.
Right. So he was orphaned, turned into a refugee.
Yeah.
Right.
So, but, I wish I knew more about it.
Yeah.
I just know that it lapsed on him, and I forget how much he totaled up. He'd paid into it over the years.
Yeah. So the winners in that, and there's three really characters in that play: the life insurance company, the agent, and the policyholder. The life insurance company won. Right? They got paid. The agent got paid, and it was all at the cost of the consumer. Now, of course, he had a death benefit while it was in force. I'm not disparaging that at all, but not a good long-term outcome.
Yeah.
At all.
He's 2 years older than I am, so he's 60. He'll be 70 pretty soon. He can't buy insurance right now. He's had heart issues.
Right.
And I think he dips. These are things he's telling me.
Right.
I mean, he can't afford it.
Yeah.
But what I'm saying is, he really has a sour taste for life insurance.
Right.
That's what's sad about the story. And it's, with the right insurance, it's not so, as we know.
Right. I give the insurance companies a hard time, and, I don't promote life insurance companies. I'm married to my wife, and I'm not married to the life insurance companies. But I give them a hard time every opportunity that I have. I mean, they've earned every black eye that they received, and they deserve most of them. That's just my opinion. If they remembered who they were and their heritage and what their real value is to the consumer, some of this stuff wouldn't go on, in my opinion. But, I can't beat them up all the time, and they'll quit asking me back, But I was talking to a gentleman the other day, and he was kind of angry because he'd become uninsurable. He bought, 20-year term, and then reduced the premium, and then bought a 10-year term, and so 30-year time period, right? Term and invested difference, kind of an idea. And he was in his mid to late 50s, but he has, heart issues, heart surgery. He's uninsurable. The bottom line, he's uninsurable, and he's kind of angry, because he can't get permanent coverage. And he's going to outlive his temporary coverage, right? Especially, I mean, it would make me angry too, and it's just terrible.
Yeah, it is sad. I mean, that's why it's important to get it when you're young, right?
Right. Well, the last policy that y'all purchased this year, was on you, young man.
Well, I'm very fortunate, though. I mean, I'm healthy. I mean, I feel like I'm healthy, and I don't smoke. So, I mean, a lot of things that maybe some others don't have.
Right.
But also, if I had it a lot younger, I know my premiums would be a lot less, and if I put that much money in, I have more insurance and obviously more value. So.
Yeah. Well, I mean, what took y'all to purchasing a policy this year at retirement? Because look, we get questions all the time. Am I too old? Is
Right.
it too late for me? Shouldn't I start on my children or whatever?
Well, I don't know. Michele mentioned earlier, all of my retirement money goes into our savings account. And we started looking at our savings account, and going, hey, we need to do something more than just let it sit in the savings account. And so we're very fortunate that, that we're able to do that. And, and so we thought, let's look into, I told Michele, I don't think I have enough life insurance. And so, I'm not getting any younger. So that's when we decided to have a meeting with you, and we decided to put all of that money into a policy, and that's what we did.
Plus, we wanted to do something more than just let it sit in a savings account.
Yeah.
Because we have our emergency fund built up. So, we're fortunate on that already. So, but his saving, we don't touch his retirement fund right now. We're in a position where we don't have to touch it. It's just savings right now. So we wanted to earn more money on it than just the savings account. And that's when we asked you if we could put it if that would be a good way to put it in another policy.
Mm-hmm. And my opinion, it was. Mm-hmm. It is.
Don't regret it for 1 minute.
Right.
Just wish I could put more in there.
Yeah, sometimes these things are hard to get past the underwriters,
I know.
Are y'all concerned at all about your future income in retirement, passive income?
I don't know that we've really looked at that yet, to be honest with you, since I still will be working for several more years. Mm-hmm. So I don't, that's probably something we need to look at, but we haven't really addressed it yet.
So you're not worried about it at this point because you haven't looked at it,
right?
I have, and I'm not worried. I'm just saying.
Yeah, no.
I'm pretty sure we're in good shape, but, again, that plan, like I talked about earlier, like, how long are we in good shape? I don't know the answer to that question. Of course, you never know the answer to that question, what's going to happen next, so.
Right.
But
I know typical, financial planning is you meet with the financial guru and we all decide on arbitrary numbers. How long are you going to work before you retire? I don't know. But we have to come up with a number and agree on it. Well, how much can you earn on your savings between now and retirement? I don't know. You don't either. But we have to agree on an arbitrary number.
Right.
Right. And then how much income are you going to need in retirement? I don't know. You don't know. But we can do some calculations and get to some kind of a number that's in agreement. And then what is inflation between now and retirement? I don't know. You don't know, but we got to pick a number. And then what about inflation after retirement? I don't know. You don't either. How long are you going to live after retirement? I don't know. You don't know. Who's going to graduate first? I don't know. You don't know. But statistically, it's you, Junior. But we still got to pick a year. Don't know. And so we take all these arbitrary numbers, and I spit them into my little black box, or the financial guru spits them into the little black box, and he prints out a financial plan, quote unquote, that we all have to feel good about. It's like, wow, it's not a successful program in my opinion, right? And so when it comes to, I'm not saying life insurance is end all to be all, and that's not the only thing that y'all do. That's not the only place that y'all put money. But positioning money where you're mitigating risk where possible. You have plenty of liquidity, which is different for everyone. And we have the ability to take income in an efficient way now or any time in the future, and then having, kind of a congruent plan, path forward. Then we get to choose when we take income from what asset and how long we take the income and make it efficient. And then what if somebody graduates? The odds of us graduating are 100%. The odds of us graduating together, not very big, you know. And it's just a completely different basis to work from. And it's almost like there's, the maximum potential, right? I don't know what the future is, and I don't want to rely on arbitrary numbers. I want to be in the best position possible and then make adjustments where we need to. And so that philosophy has served, as far as I'm concerned, me, our office, our clients, better than all the guesswork and hoping that, the market goes up one way. And anyway, so what else?
I just want to say it works. You just have to be diligent about paying back your loans, paying yourself back. Don't steal from yourself. That's another thing I remember from Nelson Nash. Don't steal from yourself. And it works. I mean, it takes time, but so does everything else. But if you're diligent about it and you look at your number, I mean, you don't have to look at them every day. You look at them once a year and say, oh, yeah, this is going up. And that's probably the best feeling, is that you're not going to lose money. It's not going anywhere. It's the only way it can do is go up. So
that's a good direction, when it comes to money.
So anyway,
it is,
But that's be my advice to everybody. It's just.
Well, I not only that, so much that, but I have comfort in knowing that, when as you graduate, Michelle's going to be in pretty good shape, A lot to be said for that. I mean, that's very important to me.
Sure.
Because I'm 7 years older than my wife. I need to share that with everybody, but I am. So it's
you're very young.
Huge. So. That's huge for me.
It is.
So
I see that a lot. We in the infinite banking world, there's a large focus and emphasis on the cash value, which is important. No question about that. And you can't buy life insurance without a death benefit. It doesn't come any other way.
Right.
But you can't negate the value of the death benefit ever. You shouldn't. Even as we continue to, age, ultimately the death benefit is collateralizing outstanding loans if we're using the cash value through loans. And at the end of the day, we do want to leave, especially our spouses and our children, better than we, or as well off as we can.
Right.
And there's not a better way that I know of that you can do that other than with life insurance, the death benefit, because you're leveraging, if I pay $1 in premium, I may have 10 or 15 times that amount in death benefit. And then it's going to pass income tax free. I'm like, wow, that's power. What else? What other financial product can you do that with on the face of the earth? I don't know. I don't know.
Yeah.
So I agree with you. It is important. The older we get, the more important it becomes sometimes. But that's hard to see when we're 20 and 30 and 40 and 50. It's hard to see the value of the death benefit.
Right.
I agree with that. But
and the other thing too, James, I admire you because you've got a tough job. Selling life insurance is not easy, and I know I know you do more than just life insurance, but there's a bad name out there for a lot of people. They don't understand it. They don't know. They think that it's like driving down the road and rolling your window down, and if it costs me $100 a month, just might as well just throw that $100 bill out the window. Right. And it doesn't work that way with all policies, and that's probably the big awakening for our kids. It was for me when I found out that you could do that with life insurance, and so that's huge.
I appreciate you saying that. I try to make it look easy.
I mean, you've got a tough job.
Yeah, that's funner. I mean, it's fun though. Sometimes it's funner than others. But I just get to talk to people like you. I get to meet people like you, and I get to talk about people like Nelson Nash.
Right.
So it's getting easier as I get older. Because maybe it's becoming more. People are becoming more aware.
Right.
Right. So. But I'm a salesman, there's no question. I'm a husband, a son, a brother, an uncle, and, a father. So I don't like to be pigeonholed just as a life insurance agent, and it's easy to do. People do that sometimes, and it's okay, and they don't know what they don't know. That's my opinion. And I remember, talking to Nelson, there's a couple of, entities out there, financial personalities and writers and radio and TV that really hate life insurance, and then they disparage anybody who writes life insurance, the life insurance agent. And it used to make me angry, And I had several conversations with Nelson about it, and tons of conversations with my wife. And at the end of the day, what I feel like they're judging me by their own character, or they're just judging out of complete ignorance, or they're projecting on good financial people, which I think most people in the financial world, their hearts are in the right spot. I mean, I think that they're legitimately trying to do good and help their clients. But there are bad apples in every industry.
Right.
And in the financial industry, it seems like there's a lot of them, and they get what they've earned, in my opinion, either in this life or the next life.
Yeah.
But they do a lot of damage, so I just try to do my part. So.
Well, you are. Thank you.
Yes, thank you. You do a good job.
I appreciate that. Okay, we want to end it there? Want to wrap it up there?
That sounds
Perfect.
good.
I had fun. Thanks for listening.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.